So we're going to talk about indicator secrets. These are secrets about how I do my trading, and I want you to know that as I just showed you before, it works. It might not go 100% right. Never does 100%. It's a miracle if it does 100%. But for the most part, these things work. And I'm going to show you now. There's a lot of indicators out there. Okay, a couple of indicators: MACD, EMA, RSI. You get a lot of acronyms. Okay, you have ATR. You have a whole bunch of indicators all over the place, and people always are wondering which indicator do I use. Okay, what indicator should I use? Should I use this? Should I do that? Some people do funny stuff. They put all their indicators together, and now it looks like a soup. Okay, now out of the soup, how do you pick the right trade, the right stock, at what price? All of that, it gets really confusing. It can get really confusing. So let me show you. Let me show you what I do. Okay. So I use two indicators, just two indicators. I don't use more than that. And those two indicators are basically the EMA, which is exponential moving average. Okay. So yeah, the EMA is the exponential moving average, and this basically gives us an understanding what is the change in the direction or the trend of the share or the market as a whole. Okay. And so I use this basically the exponential moving average to decide what is the direction of the share, whether it's going up or going down. Okay, that's the basic thought that I use the indicator for. And now I know that a lot of people try to think, okay, I need to use all the indicators, which is wrong. Then there's another set of people who say I'll use only one indicator, which also is wrong. Okay, because I want you to know, no one indicator can give you the right answers all the time. Okay, and I will show this to you. There is no way one indicator can give you all the right answers all the time. Every indicator, for example, most indicators are called lagging indicators, which means by the time they give you an indication, the market would have moved a bit already, because the indicators are actually based on the prices that happened in the last time period, at least. All right. So you don't get a trend from the indicator before the trend happens. Okay, it's not a, what do you say? It's not a crystal ball. Give me the trend. Okay, it's not. Mostly all of them are kind of lagging. There is no actual leading. Okay, you can make an understanding of this is where it's going by watching the indicators, but the indicator doesn't fire up before the trend actually happens. You get that? Because then there will be a miracle. If, for example, that's like me saying, hey, 10 minutes from now, this stock is going to go up with no other, I'm just saying that. So I'm now a leading indicator. 10 minutes from now, this stock is going up. How do I know what's going to happen 10 minutes from now? But if I say, based on what I've seen in the last 10 minutes, I believe that the stock is going to go up. I am a indicator, and at best a lagging indicator. So most indicators are lagging, okay, because it's based on the previous prices. Now the exponential moving average reveals changes in direction. Okay. Now how does this work? Okay, assume we have prices. Okay, 1, 2, 3, 4, 5, 6, 6. Over 6 periods we have these prices. The average, so the EMA or the moving average would be 21, which is 1, 2, 3, 4, 5, 6. Please add it up. 21 divided by 6, 3.5. Okay, so that tells me the average is 3.5, right? So this is the basic thought behind a moving average. Very simple. Okay. Now the difference is the moving average is actually the average of the specified period. For example, if my chart is showing 1-day chart, okay, that means the moving average is based on 1 day. Okay, every day is one separate. In the set, each element is 1 day's price. Okay, if it is 15 minutes, each element in the set is of the 15 minutes. Okay, 15, 10, 15, 10, 30, 10, 45, 11, so and so. Okay, and so 21, let's look at an example. 21 EMA for 1 hour period is actually the average of the price over the last 21 trading hours. Okay, not the hours when you were all asleep or when the market was closed, but the last 21 trading hours. And a 50 EMA for a 1-day period would actually be the average of the price over the last 50 trading days. Okay, again, not the days when the market is closed, but all the last 50 trading days. So 50 EMA is not automatically 50 days. Okay, it is based on the period. So one issue with this, okay, now this is an example of a Great. This is a company called Siemens, and you can see two lines there. Those both are EMAs. Okay, so you can have multiple EMAs. Some people I have seen people will have 9, 20, 150, 100, 200 all on the same screen. And you look at it, you're like, what is going on here? Okay, you can't make head or tail of this. And so it is very important that you use more than one indicator, but you don't use more than you don't use 100 indicators. I think the best a good set would be to give you a good trend. Okay, whatever would take you to understand and analyze the market is the good number that you should use. Okay, so now look at these two. I have two indicators here. The blue is the 21 EMA and the red is the 50 EMA. Now most people would tell you, okay, so now we know it's the averages, right? So if the smaller average is higher in value, that means the price is higher. And I think I've explained this before. Okay, so assume the last 3 days the prices were 100, 120, and 150 or 140. So the average is 120. But the price over the last 10 days has been 10, 20, 30, 40, 50, 60, 100, 110, 100, 120, 140. Okay, so which is the larger average? Is it the 3-day average or the 10-day average? What do you think? The 3-day average is around 120, and the 10-day average by that calculation, rough calculation, would be around somewhere 60, 70, right? Yes. So the 3-day average is better, is higher or of more value than the 10-day average, which means the price has increased. If you see, in the first 7 days of the 10 days, it was 10, 20, 30, 40, 50, 60, 70. And then the next 3 days was 100, 120, 140. So the price has actually increased. Okay, so that's the same. It's a mathematical principle. There is no mumbo jumbo or magic in this. It's just maths. Okay, it's just ellan kanaka. It's all maths. And so the average, if you see, when the smaller period average 21 is above the, you can see in the first part, the 21 is above the 50 average, right? So what that means is the price is going up. If you see the candles, you can see that the price has gone up. Over here at the start of this chart, it was around 1040, and then over here when you look, it's around 1090 or almost 1100. All right. But when you see the trend change, okay, look at this. Here you see the 21 EMA goes below the 50 EMA, which means now the latest prices are lower than the average. Okay, that is why it's dipping down. And you can see here, when that happened, the price started moving down from 1040-ish, and it went down, 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 down. It came all the way here somewhere in this range was 1000, somewhere around 1000. All right. So most people will say, hey, when you see the 21 go below the 50, or the 9 go below the 21, or the 50 go below the 200, or whatever like that, that means the trend is bearish. You got to sell. Okay. Yes, trend is likely to be bearish, but sometimes it can go wrong. Okay. Or if the 21 goes above the 50, or the 9 goes above the 21, or the 100 goes above the 200, we'll buy. But it's not always right. Okay. We got to analyze this properly. So what you see here is that the 21 EMA goes below the 50 EMA. So from 1040, it went to 1000, right? But so the trend was bearish, and you can see the price drop, right? You got this, right? Now I want to show you something. Okay. So these are the things that we know. When the lower EMA goes above the higher EMA, that means it's a buy signal. When the 9 goes above the 21, and the 21 goes above the 50, a buy signal. It doesn't mean you have to buy. It's just a buy signal as per the EMA crossover. And when the lower EMA goes below the higher EMA, again, sell signal. Doesn't mean you have to sell. It is just an indicator that the trend is moving downwards. All right. Here's my tip to you. The success rate of this strategy is only 53%, which is actually a good percentage, by the way. Anything that's above 50 is good, but it's not 100%. You see that? 53%. And how do we do this here? Well, first time you do, you might win. Second time you do, you might lose. Sometimes you might have 3, 4 in a row that you lose, and then you have 4, 5 that you might win. How do you do this? It gets confusing, right? And so I want you to understand, one indicator does not make a lot of difference. You have to use more than one, but not too many. Okay. And so, like I said, I just use 2. I use the EMA, and I don't use 2 EMA lines. Okay, I use 1 EMA line. I'll show you this at the end. And I use the MACD, which is the one we're going to talk about. I also use something called the average true range for the stop loss indicator. It's not an indicator by itself, in the sense that it doesn't give the trend. You can look at it and figure out a trend, but it actually gives me a stop loss indicator. All right, but which I won't be discussing here. I'm trying to show you how you figure out where the stock is going. Okay, I'm not trying to show you what the stop loss value is, which we'll do it in a later session. Okay, so when we see that the lower goes above the higher, buy probably, yes, okay. And when the lower goes below the high, sell probably, okay. But I want you to know that the success rate is around 53%. Now, who did this? There have been people who have back tested this strategy, and they figured out that it averages around 53%. They've done 100 trades, only 53 of them went right. Okay. Now the next one is the MACD. This is my personal favorite, uh, you know, indicator. It's an oscillator. Basically, it is the moving average. It uses two moving averages and compares it with the third one. So it's like the EMAs combined together. It's like transformers. They combine something like that. I don't know. Weird stuff. Or Voltron. That's what I should have said. Voltron. The lines combine together, becomes a huge robot. And so the MACD is like that. You have three indicator moving average lines coming together, and so what this shows is a couple of things. It shows direction, which also the moving average does. Because this is moving average, it's a mix of moving average. Of course, if the EMA shows direction, or so does this MACD. But it gives a few more things. It shows momentum and it shows strength. Okay, and now let me show and I'll tell you how this works. Okay, so let's get first the technical details of this. Okay, I will show you what the chart looks like. But first, let's look at this. There are three things on an MACD indicator. Three. All right, remember three. One is the MACD line, which is normally by default blue in color. Okay, and this is actually the default value, and you shouldn't change these default values. The default value is it takes the 12 range EMA and it'll minus the 26 range EMA from the 12. Okay, and then there's a signal line, which is orange in color. Usually you can change these colors, and that is usually the 9 range EMA. Now, when I say range, I basically mean whatever the time frame is. Okay, if it's 1 day, it becomes a 12-day minus 26-day and 9-day EMAs. If it's 1 hour, it's 12 hours minus 26 hours EMAs and the 9-hour EMA. Okay, so that's why I said range. Okay. And the MACD histogram it's like a bar graph. Okay? Lots of skyscrapers and stuff. That is actually the difference between the MACD value and the signal value, and it's plotted as a histogram. Okay, so this is what it looks like. Okay, all of that thing comes out into this. See, you have a blue line. Okay, squiggly, and you have an orange line. Okay, there you go. And then you have this marvelous looking fancy red and green histogram. Okay, and this is the default value that you can see. Now, most people, so the MACD line is the blue, the signal line is the orange. Just for those of you who didn't get it when I said it, you can watch the video pictures and make it out. Okay, and the histogram. Now, these are all important. For me, histogram is very important. And the crossover. Okay, so let's what I mean by now look at the histogram. Okay, let me just quickly explain the histogram. You can see here that there are the the dark greens, the light greens, the dark reds, the light reds. Okay, this is actually showing momentum. Okay, the larger the the histogram gap gets, or the histogram either the gap between the blue and the red, which is the same exactly as this, the larger it gets, or the larger it goes down, the more momentum there is. Okay, so look at this. For example, when you see here, the momentum was increasing here. You can see up, and even though the price itself is not very clear, you can see that there was a shift in the price, right? And you can see similarly when there's a decrease, you can see over here when the red, there was a decrease, there was a momentum going downward momentum. The price also decreased downward. Okay, in this the last 1/3 of this thing. Now let's look at an example. Okay, which again taking Siemens. Okay, this is a trade. This is a share that I traded yesterday, so I thought I'll talk about this. Now you can see here there's an MACD crossover where the blue line is going below the orange line. What does that indicate? Blue going below orange. What does that indicate? Anybody knows?
Sell.
Yeah, sell. Okay, so it is a bearish trend. You can see that the trend is bearish, and you can see. Okay, so when it crossed over, the price was around 1,080 something. By the time this trend got over, the price was around 1,000. So that's 80 rupees. This is actually happening in one day. Okay, so this is 8% of a drop, 8% or 9% drop, and I would have got in if I had seen this. Okay. Now So what do we know? When the MACD goes above the signal line, buy signal, not necessary that always will work, but buy signal. And the MACD goes below the signal line, sell signal again, not always that will work. Right now, this is the funda behind this. The MACD is probably the most successful standalone indicator strategy, has 62%. Now, here's it, standalone, most successful, 62%. You get that? I told you the best traders get about 60 to 70% of their trades right every day or in average. And the best indicator standalone is 62%. Okay, it's not anywhere near 80 to 100%. So how do we do this? Okay, again, you cannot use one indicator alone. You got to use a combination, but you got to use a wise combination. You can't have 100 indicators. You won't make any sense of it. It looks like what's happening. Okay, so I use two indicators. I use the 21 EMA and the MACD. Now I want to give you some context here. When I'm talking about 21, I use the 21 EMA because it's from my what I've done over the past years. The 21 makes best sense when it comes for short term or intraday. Actually, intraday 21. If it's short term, say for the week, I'm holding a stock. I'm either selling or buying a stock for the week. Then it'd be somewhere between 50 to 100 EMA. If it is long term, always 200 EMA. I will never make a long term decision using a 21 EMA. It makes no sense. Okay, because what is a long term holding? It's roughly 1 year, right? How can I use 21 days of EMA to make a decision for a 200 or 300-day holding? You get that? So I want you to know that it doesn't work that way. It is always better to have a larger indicator. So if I'm holding it for 1 week, I would use 50 to 100, which is like almost 7 to 14 times the average. If I'm holding it for say 3 months, 90 days, I use the 200 EMA, which is roughly double. If I'm trading on 1 day, within the day, intraday, I'm actually using a 21 EMA, which is over the last 21 times. Okay, because this gives me a better indicator. It doesn't give me false signals. It reduces a lot of the the noise and all of that. So basically, and I realized for intraday, I don't use, if I use 50, I will never get it, because many times it'll just stay very close to the line and the divergence is not very clear. So for me, 21 and the MACD. So these are the two signals that I use. Now I want to show you something. Okay, when we looked at the first one, the EMA. Okay, I don't know if any of you noticed this, but here when the EMA cut, you see where the crossover happened. The 21 goes below the 50. We would have only got in at 1040, and we would have sold off at about 1000. All right. So how much would I made? We would have made about 50 rupees, right? Okay. But I want you to know something. This actually trend started here, somewhere around 1080. Okay. Just by using this indicator alone, I would have gotten late. I still would have made money, but I would have gotten late. Okay. Now let's go to the MACD one. Okay. Now MACD, when we take that example, you will see that here it actually did make the signal a little more earlier. Okay, that this is going to lag, it's going to go down. And so that trend became clearer by this red candle. But the problem here again is that we normally get the signal at the end of this red candle. By that time, the price is around 1060. Okay, roughly 1060, somewhere in this red candle, 1060. Okay. Again, we're missing out on the larger portion, which is not bad. Okay, you don't have to necessarily get in at the best values. You can get in somewhere in between, no problem. But I always found it makes more sense to do these indicators together. So now look at this. I'm using the 21 EMA. Now look at this. The 21 EMA, again, it's on the second line. The line cutting is at the as at about 1070, which is a little better than the previous two things. 1070 is where I noticed the line cutting. Okay. At the same time, the MACD signal. Now the MACD signal actually is somewhere in this range, but I'm using both these indicators to decide, hey, this is a stock that I want to sell now. Okay. So what I normally do is, if I entered there, I would probably exit somewhere in this range. Okay. Again, we don't know where the precise. I can always, after the entire day is over, I can say, oh yeah, I should have sold at You know, 996, 994. But normally we don't get the best values. I'll show you many times where, and if you've seen the shares that the trades that I've done, I don't get out and get in at the best prices. Nobody does. Okay. Uh, Nobody can make that move because we don't know what the best price is going to be to exit. So we can at best do the best price to enter, and because sometimes the market moves fast, we might not get even at the best price. Yesterday it happened like that. I'll show you an example. Okay. And so this is what we should do. Okay. But it doesn't always work out that you get in the best and you get an exit. But my basic thoughts here is that first I would try to get in. If it's going down below the line, I would try to get in close to the line, because then I can get my entry point just below the 21 EMA, so my stop loss can be a little above, and this is safe. Okay, what happens if I get in, say here, 1000, let's say 1020, 1030? If I get in at this point somewhere here, 1030, my stop loss is going to be large, which is really bad actually, and so I wouldn't get into this trade. Let's recap. Okay, don't use too many indicators. Use a couple of indicators that work for you, and indicators don't give you the exact pictures. Okay, I just want you to know 63%, 52, 53%. These are not great numbers, but they're okay numbers. So buy a strategy, for example, a strategy of 60%. You will see after 100 trades, you will get 40 wrong and 60 right. That is 20% profit. If you follow rules, otherwise what happens? Most people will do their 40% really badly, and they'll do their 60% just so and so. So they end up losing overall. The key is to do all of these together the same way. It's like, all at the same level. 40% loss, people don't honor their stop loss, people forget to put stop losses, lots of issues. You got to boil it down. This is what I'm so in the end, I think indicators, don't have too many. Use the ones that work for you, a few. Make decisions based on, use the indicators to make a decision, but don't make the decision based only on indicators alone. Watch the market trend. If the indicator is saying it's bullish and the market is going down, trust me, if the market is really going down, even your share will go down. There might be some shares which will go up, which we can see. We have seen Asian Paints, M&M, but mostly that is because they did a technical breakout. Okay, if there is a technical breakout, yes, it makes sense. But otherwise, it's going to go down with the market. A banking share showing bullish, but the bank nifty is falling. That tells me that most of these banks are going to fall. So things like that. Please be careful. I hope this helped. Anyway, thank you so much for listening for 1.5 hours. I didn't realize this goes so long, but I'm really appreciative of everybody listening in. Any questions you have, please do follow up. Ask me on over WhatsApp. I'd be more than willing to answer. I'd love to answer. I want to help you guys. Uh, I want you guys to know that this is not so hard as you think it is. It is not easy, or it's not so hard also. As long as you follow rules, you can make money.